Welcome to the Deep Dive. Today, we're tearing apart the Q3 2025 earnings call for Melco Resorts and Entertainment. That's ticker MLCO.
Yeah, MLCO has been such a fascinating story this year. You've got this heavily leveraged operator in a recovering market.
So our mission today is to really get into the weeds. What drove this massive profit surprise?
And more importantly, did the management team finally, cement the recovery narrative? Yeah. Have they moved from a solvency story to a real growth story for you, the investor?
Let's start with the snapshot then, because the numbers were so strong the stock popped immediately. The market loved this.
It really did.
Total operating revenues came in at $1.31 billion US dollars.
So a modest beat on the top line.
A slight beat, yeah, about 11% year-over-year growth. Mm-hmm. But the real story here, it wasn't the top line. It was all about the margins. The profitability was just extraordinary.
Talk about it.
Okay, so adjusted EPS, that's earnings per share, it landed at 21 cents per ADS.
And the consensus was, around 11 cents? Exactly. So that's a profit surprise of over 90%. It just crushed expectations.
90% is huge. That tells me something structurally powerful must have shifted, not just a bit more foot traffic.
Well, let's look at the core health metric. The adjusted property EBITDA, which is basically their cash flow from operations.
Right.
It hit $380.4 million. The consensus was way down around $320 million, so that's almost a 19% beat.
And that flows straight to the bottom line.
Precisely. Net income attributable to MLCO, it nearly tripled year over year, $74.7 million. And this wasn't just about cutting costs. This was high-yield revenue coming in the door.
Okay, so let's unpack that. Where did $60 million plus in unexpected EBITDA come from? You don't just triple your net income by accident.
It's one story, really. The driver is the Macau premium mass recovery.
The high-end players.
The high-end players who used to come through junkets but now deal directly with the casino. Management was crystal clear on this. That segment is the engine. The Macau properties alone. Their EBITDA grew 21% year over year.
Okay, we have to pause on that because this is a crucial point for anyone listening.
Mm-hmm.
Why is servicing premium mass so much better for the business than the old VIP junket model?
It fundamentally changes the entire margin profile. I mean, with the old junket system, the casinos had to split a huge chunk of the revenue.
The junket operators.
Yeah. So when those high rollers transition to premium mass, Melco keeps 100% of that revenue stream.
So it's higher margin and probably lower risk too.
Much lower regulatory risk. You're not dealing with third-party debt collection and you're building loyalty directly. It is the definition of a structural tailwind for them.
And what makes that 21% growth figure even more impressive is they had some headwinds in the quarter, a significant weather event, right?
A huge one. They took about a $12 million negative hit because of a typhoon in Q3.
So operations were just shut down.
Shut down or severely curtailed. The fact that they still posted 21% growth after eating that $12 million charge, it just speaks volumes about the underlying demand.
Okay, but how do we know this isn't just, a blip, pent-up demand after the storm that maybe inflated the numbers? Is this sustainable into Q4?
They gave us crucial real-time evidence on that. The CEO, Lawrence Ho, was very clear. He said momentum did not slow down after the Golden Week holiday.
Okay.
He confirmed Macau's overall gross gaming revenue, that's the total casino win. It grew over 30% year over year after the holiday.
And for MLCO specifically?
Critically for them, City of Dreams had its highest ever monthly mass table GGR in October.
Wow. So Q3 wasn't the peak.
It was a step up. It looks like they're heading into a very strong Q4.
And this isn't just luck. I mean, there's a strategy behind this. They've been making specific investments to drive this.
Absolutely. It's a mix of targeted upgrades. At their flagship, City of Dreams, they just completed the new signature clubhouse.
Aimed squarely at that premium mass customer.
Exactly. And they also announced a $125 million renovation of the Countdown Hotel. It's due to reopen in Q3 2026, fully geared toward that premium market.
At the same time, they're trimming the fat from the portfolio to boost efficiency. Tell us about the Mocha clubs.
That's the portfolio reshaping piece. They're closing 2 more Mocha clubs by year end. These are, low-yield neighborhood slot parlors.
And they're taking those machines and
reallocating them, moving them to higher productivity, premium spaces like Studio City. They also moved 15 gaming tables from the Grand Dragon Casino into a new area at City of Dreams.
What's the direct efficiency gain there? Is it labor?
It's primarily yield and customer flow. Those 15 tables at Grand Dragon probably had low minimums, erratic volume.
Got it.
You move them into a high traffic spot near the Grand Hyatt at City of Dreams, and suddenly you can increase the minimum bet. You ensure they're always full. You're just optimizing the earning potential of every single square foot.
Let's look beyond Macau for a second. How are the global diversification efforts going?
City of Dreams Mediterranean in Cyprus is ramping up really well. It was their best quarter yet. Adjusted EBITDA up 53% year over year.
That's a huge number.
It is. It's proving the model works outside Asia. City of Dreams Manila is a bit more mixed. Strong sequential growth, up 45% from last quarter, but it was actually down a little bit year over year.
And Sri Lanka, the new market.
Very early days. Management basically said they're still learning that market, especially how to capture that premium Indian customer. We should expect some volatility there for a bit.
So this all brings us back to the big issue that has always hung over MLCO, the balance sheet. They're sitting on roughly $7.35 billion in debt. With this new profitability, can they finally start to tackle that mountain?
This profitability surge completely changes the credit story. They are executing a really strong deleveraging plan.
What did they do?
They issued $500 million in new notes due in 2033 to push out their maturities. That's a huge vote of confidence from the debt market.
And they're actively paying down debt too, not just refinancing.
Critically, yes. They paid down about $180 million of debt in Q3 alone, plus more after the quarter. The result is they have no material amount of debt maturing in 2026. That removes a massive near-term risk.
That $7.35 billion starts to look a lot more manageable when you're generating $380 million in EBITDA a quarter.
It gives them so much more room to breathe.
What about guidance? What do they tell us to expect for the next year?
We got some interesting details on spending. For Q4, they guided to slightly higher operating expenses in Macau, around $3 to $3.3 million a day.
That seems counterintuitive after such a good quarter.
Well, it's intentional and strategic. It includes one-off costs for hosting the China National Games and for Studio City's 10-year anniversary. They're spending to drive traffic.
And for 2026?
A preliminary placeholder for capital expenditure of around $400 million. So still investing.
But the most critical shift, the thing investors have been waiting for, the capital return plan.
This was, for me, maybe the single most important statement on the whole call.
Okay.
While debt reduction is still a priority, management announced a definitive shift. They signaled a clear intent to potentially resume a quarterly dividend by the end of 2026.
That is a fundamental change.
It's the moment the story officially pivots from just survival and debt paydown to a real growth and capital return story.
So if we connect that to the broader market, we know Macau is recovering. October GGR was $3 billion, strongest month since 2019. But it's still below pre-pandemic levels. They're fighting for every dollar.
And management was very blunt about the competitive environment. The CEO basically said the problem is that their peers are obsessed with chasing weekly and monthly market share instead of focusing on profitability, on EBITDA.
He's trying to talk some sense into the market.
He's almost pleading for a more rational, profitable environment for the whole industry.
Let's talk about the other big catalyst on the horizon, the strategic review of City of Dreams Manila.
Right. That review is almost done. Management said a decision, which could be a sale, a joint venture, or just keeping it, is expected by the end of 2025.
And a sale would be a huge deal.
A massive capital event. It could rapidly accelerate the debt paydown and maybe even pull that 2026 dividend timeline forward. It's a huge potential catalyst.
And the stock performance reflects this. MLCO has just destroyed its sector. The main gaming ETF is down over the last year, while MLCO is up, 45%? Investors are buying this story.
They're definitely executing.
Okay, time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea to the hypothetical investment committee.
All right, so the thesis is clear. MLCO is pivoting from a leveraged Macau recovery play to a balanced growth and capital return story. Q3 confirms the operational momentum is there. But we have two major near-term binary risks: the Macau 2026 policy address and whatever happens with that Manila review. Either one could derail the dividend timeline and hammer the stock.
So how do you play it? How do you capture the upside from Q3's momentum, but protect against those big, unpredictable risks?
We propose what we're calling the protected premium play.
Okay.
The idea is you go long MLCO stock, You want to capture that upside from the Macau mass segment, the deleveraging, and the eventual dividend.
Well, you have to hedge the big risk.
You have to neutralize the policy and M&A overhang. So to do that, we hedge the exposure by buying an out-of-the-money put spread.
A put spread. Cheaper than buying a straight put, but it gives you that defined downside protection.
Exactly. And the key is the expiration date.
When are you targeting?
We target an expiration in early 2026, let's say the March series. That gives us protection specifically over the window when we expect the Manila decision and when we might get news on the Macau policy address.
So if there's a negative surprise from either of those events,
the put spread gains value and offsets the drop in the stock.
so you're basically paying a small premium to protect that 40+% gain you've already made, letting you hold the long position with confidence through the volatility.
That's it. You're capturing the organic growth while neutralizing the very specific political and transactional risks that could disrupt that path to the dividend.
A powerful synthesis. So to wrap up this deep dive, the key takeaway is that Melco delivered a massive profit beat. It was driven by that high moves in Macau premium mass segment and some very proactive capital management.
And it sets the stage for a potential dividend return by late 2026.
A huge pivot.
My final provocative thought for you to consider is this. Management is intentionally raising its Q4 operating expenses for promotions and events. That means Q4 margins will be temporarily suppressed.
So the question is,
will the investment community penalize the stock for those lower short-term margins? Or will they reward the underlying strategy of spending now to drive that valuable long-term premium mass market share? That test is going to tell us a lot about how the market views Melco's vision heading into 2026.
A great question to mull over. Thank you for joining us for this analysis of the Melco Resorts results. We'll see you for the next deep dive.